Look, we've all heard it 100 times. Keep your money safe in the bank. Sounds sensible, right? Secure, peaceful. But here's the thing, the bank isn't keeping your money safe, it's slowly making it smaller. Every month that your cash just sits there, inflation quietly eats away at its power. In India, inflation has averaged around 5.5 to 6% over the last 2 decades, while most savings accounts pay about 3 to 3.5%. That means your money isn't growing, it's shrinking in real terms. If you had 10 lakh rupees in a savings account earning 3.5%, you'd get 10.35 lakh rupees after a year. But with inflation at 6%, what you can buy actually drops to about 9.76 lakh rupees. You lose 24,000 rupees of purchasing power without even noticing. Here's what most people don't realize. The rich rarely keep idle cash lying around. They keep enough to handle 6 to 12 months of expenses. Bas, that's it. The rest, they deploy it. They don't gamble, they strategize. They spread money across assets that protect against inflation, generate cash flow, and grow steadily over time. ऐसा ही राकेश झुंझुनवाला करता था, conviction के साथ invest करता था, लेकिन calculation के साथ. So today, let's explore 5 safer assets rich Indians use instead of letting cash rot in the bank. Now, you might be thinking, wait, isn't cash the safest thing? Not really. It feels safe because it doesn't fluctuate on a screen. But that stability is fake. It's silently eroding. See, inflation is like termites. You don't see it working, but one day you realize the structure is weaker. Rakesh Jhunjhunwala once said, inflation is the biggest enemy of the common man. He meant that keeping money idle is like tying your hands while the world moves ahead. So the goal isn't to avoid risk, it's to choose the right risks. Let's go through what the wealthy actually do with their cash, starting with the simplest and safest options. Here's the thing, the rich love safety with purpose. That's why one of their favorite cash alternatives is government securities, or GSECs. These are bonds issued by the Reserve Bank of India on behalf of the government. Essentially, you lend money to the government and earn interest. Long-term Indian government bonds have historically yielded 6 to 7% per annum, while short-term treasury bills average 5 to 6%. That already beats most savings accounts. Let's do a little math. 10 lakh earning 7% grows to nearly 19.7 lakh in 10 years. That same money at 3% would be 13.4 lakh. The gap? 6 lakh rupees for the same level of safety. These instruments are backed by the sovereign, so credit risk is virtually zero. Liquidity is good, especially now that retail investors can access them directly through the RBI Retail Direct platform. So if you want your emergency fund to stay liquid but still productive, this is your first step beyond the savings account. Here's what most people don't realize. Rich investors often prefer being the lender instead of the depositor. They buy high-quality corporate bonds or invest through debt mutual funds that hold diversified baskets of such bonds. Typical returns? Around 7.5 to 8.5% per annum for AAA rated corporate debt. Some top-performing short-duration debt funds have delivered around 7% annualized over the past decade. Now, you might be thinking, but aren't corporate bonds risky? Yes, if you chase yield blindly. But smart investors spread risk across issuers and stick to high credit ratings. Think of it like this. Instead of your money working for the bank, it's working for productive Indian companies, Infosys, HDFC, NTPC, through their bonds. A diversified bond portfolio gives steady returns, minimal volatility, and periodic interest payouts. Perfect for those who want predictability without sacrificing growth. Now let's move from defense to offense, equities. Jhunjhunwala built his wealth through conviction in India's growth. He believed the Indian economy would compound faster than inflation, and he was right. The Nifty 50 has delivered a compound annual growth rate of about 11 to 12% since inception. Mid-cap indices have done even better, around 14 to 15%. If inflation averages 6%, your real return from equities is 5 to 6% after adjusting for price increases. That's real wealth creation. Let's simplify with math. If you invest 1 lakh rupees per year for 20 years in an index fund growing at 11%, you'd have around 65 lakh rupees. If you kept that same amount in a fixed deposit at 6%, you'd end up with about 38 lakh rupees. That's nearly double, and all because you chose to own businesses instead of just lending to them. Now you might be thinking, but equities are risky, yaar. True, in the short term, but history shows the risk reduces with time. Over any 10-year rolling period, Nifty 50 has beaten fixed deposits more than 90% of the time. The rich understand this. They use systematic investment plans to ride volatility. As Jhunjhunwala used to say, markets are always right. Your patience decides your profit. So diversify, automate, and stay invested. Now India and real estate. Wah, emotional connection hai. For generations, owning property has been the dream. But rich investors approach it strategically, not sentimentally. Residential real estate in metros yields about 2 to 3% rental income and around 5 to 6% long-term appreciation, giving a total return near 8 to 9%. Commercial real estate through REITs can do even better, 10 to 12% total return with liquidity because REITs trade on stock exchanges. Imagine earning quarterly dividends while owning a slice of office towers in Mumbai or Gurugram without worrying about tenants or maintenance. That's how the rich think. Tangible assets, predictable income, no emotional baggage. Jhunjhunwala himself invested in real estate related businesses, but always focused on utility and future demand, not glamour. Real estate adds stability to a portfolio because it tends to move differently from equities or bonds. In short, diversification that pays rent. Gold, the timeless Indian obsession. From weddings to Diwali, it's emotional, traditional, and financial all at once. The wealthy still love gold, but they treat it as insurance, not a growth engine. Over the past 20 years, gold in Iron Rupees terms has compounded around 9 to 10% annually, slightly above inflation but below equity returns. However, gold performs best when uncertainty rises, during high inflation or market stress. Modern investors prefer sovereign gold bonds. They track gold prices and pay 2.5% annual interest. Hold them for 8 years and gains are tax-free. That's smart diversification. Hedge your portfolio, earn interest, and stay liquid. As Jhunjhunwala put it, gold is protection, not progression. Now ये सब numbers ठीक हैं, but let's talk mindset. Because here's what most people don't realize. Wealth isn't built by products, it's built by perspective. Average investors want comfort. Wealthy investors want control. When you keep money in the bank, you give up control. To inflation, to interest rate cycles, to someone else deciding your yield. When you diversify intelligently, you reclaim it. Behavioral finance tells us humans fear losses twice as much as they love gains. That's why many cling to cash. It feels safe. But volatility is temporary. Inflation is permanent. The rich understand this psychological trap. They accept small fluctuations for long-term stability. They know temporary pain for permanent progress. They also think in decades, not days. Jhunjhunwala held stocks like Titan for over 20 years, compounding quietly while others panicked over short-term dips. Soch badlo, result badlenge. Alright, let's turn all this gyan into practical steps. Step 1. Keep only 6 to 12 months of expenses in your bank account. That's your emergency cushion, nothing more. Step 2. Move surplus cash into government bonds or treasury bills for 5 to 7% safe returns. Step 3. Add corporate bonds or debt mutual funds for 7 to 8% steady income. Step 4. Start SIPs in equity index funds or diversified mutual funds to build long-term wealth. 10 to 12% expected CAGR. Step 5. Include REITs or a property investment for stability and income diversification. Step 6. Allocate 5 to 10% to gold or SGBs as insurance against volatility. Step 7. Review annually. Wealthy people treat their portfolio like a business. They audit performance, rebalance, and stay disciplined. Remember, safety isn't the absence of risk, it's managing risk intelligently. Let's be honest, the comfort of a bank balance is emotional. Seeing that number feels secure. But security isn't about the number staying still, it's about its power staying intact. Rakesh Jhunjhunwala started with 5,000 rupees. He didn't hoard it, he multiplied it. Not by chasing shortcuts, but by letting conviction compound. He believed in India, he believed in the market, and most importantly, he believed in the math of patience. So here's the takeaway. Don't let fear of losing money stop you from growing it. Your money's job is to work for you, not nap in the bank. हर रुपी को काम पे लगाओ. Every rupee you move from idle to active is a step toward financial freedom. Here's the thing, the bank keeps your money safe for them. The rich keep it productive for themselves. अब decision आपका है. So the next time someone says, at least your money is safe in the bank, smile politely because you'll know better. True safety isn't in hoarding, it's in understanding. Understand where your cash sleeps, where it works, and where it grows. As the big bull himself showed us, conviction, patience, and a bit of courage can turn even 5,000 rupees into an empire. Look, inflation will keep rising, markets will keep swinging, but the principles of smart investing, they never change. So start today. Move your money with purpose because the safest place for your cash is where it's earning its keep.